Morning and welcome to the Bowmans 2024 budget speech webinar. I'm Mike Benetello and I will be the moderator for today's session. And I'm joined by the following panelists. I'm joined by Francois Fouche. Francois is a research fellow at the Gordon Institute of Business Science Center for African Management and Markets, and he's also a director of Boundless Advisory. Francois hails from the earlier Wharton Economic Forecasting Associates, a USA-based commercial think tank, founded by Nobel Prize winner Dr. Lawrence Klein. Today, Francois advises central banks, governments, and industry on all matters trade and investment related, like evidence-based export strategy development. Welcome, Francois. I'm also joined by three of my colleagues, all tax partners from Bowmans, Yasmeen, Suliman, Roné and Robyn Berger. And we hope to point out to you some of the more interesting things and aspects in the budget. But before we kick off, maybe some housekeeping issues. The session is being recorded. I think for the benefit of everyone, we've disabled the chat function, but we have enabled the question and answers function. So please do make use of that. And I will put as many questions as I possibly can to the panelists during the course of the session. The notes, being the slides and the recording, will be made available on the Bowmans website sometime next week. And we will be issuing CPD certificates for the session. And if you haven't received your CPD certificate by March, then please do let us know so we can attend to that. So starting off with yesterday's budget, I think it was quite an interesting budget from a personal perspective. I really did enjoy the aspects raised by the Minister of Finance, especially the fact that the pie wasn't growing sufficiently and all the other aspects that he dealt with. But I'm not an economist, and I'm going to ask Francois to take us through, in his view, the more important aspects of the budget from an economic perspective and unpack in more detail. Over to you, Francois.
Thank you, Mike. Can you just give me an indication if you can see my screen? You should be able to.
Yes, we can, Francois.
Excellent. Thanks a lot, Mike. Delighted to be here with you this morning. I want to take the next few minutes to quickly provide some insights in as far as the economy is concerned about yesterday's budget. The budget yesterday was a bruising affair. No big surprises and a rather short budget speech. But the grab for the pot of gold, the so-called Jafekra, was a disappointment. Even though it will happen subject to certain terms and conditions. We could have avoided the mess we are in, the debt mess that is, if we didn't score so many own goals in the last decade on the fiscal side. Yesterday was an austerity budget. Our reserves are being used to reduce our debt load. In my mind, however, a more disciplined fiscal management approach over the last decade and a half could probably have prevented this. Jafekra cannot save us. It will make our debt service cost a bit more bearable, at least in the short term, but it is too late to turn the debt ship around overnight. The debt service costs in South Africa are out of control due to our inability to stick to budget promises over so many years. Bailing out state-owned enterprises remain the single largest risk for the fiscus, and this has unfortunately not been addressed yesterday. I found this rather disappointing. I cannot score a budget with so many line items and levels of complexity with a single good or bad number. The devil is in the detail, and there are many, many details. So let's jump into some of them. I think overall, the verdict on the budget, do no harm, would go a long way to help. Another lens to evaluate whether our budgets have been good or bad is to think about, when a policy is being considered, it needs first to be measured against how it will impact our competitiveness, especially our global competitiveness. Our debt accumulation over the last decade and a half has done considerable harm to our level of global competitiveness. The market's reaction overnight, nothing meaningful. If we look at the value of the rand largely unchanged, strengthened a little bit in the first hour or so when the announcement was made yesterday. Keep in mind that the budget is a promise of what National Treasury wants to see play out. The market knows, however, that it typically does not turn out that way, especially over the last few years. What can we say about the level of transparency, at least in as far as fiscal policy is concerned? We can say many good things, fortunately. South Africa has a strong record of fiscal transparency and consistently ranks among the top 3 countries worldwide when it comes to fiscal transparency. So we are very good at illustrating how dire our fiscal picture really is. Changing the picture is an area where we can certainly improve, though. A predictable and a transparent fiscal policy environment, of course, underpins macroeconomic stability and is rather important. So later this year, and this came out yesterday in the budget review statement, later this year, the IMF will publish the results of South Africa's most recent fiscal transparency evaluation. And the report, National Treasury indicated, will note a strong performance in fiscal reporting and in budget transparency, but it certainly do contain some suggestions for improvement from the IMF. And one area that they mentioned is fiscal risk analysis. So enhance the analysis of risks in the fiscal risk statement, for instance, to publish more public-private partnership financial data on a regular basis, to consolidate the transfers to state-owned enterprises to show the fiscal impact, and then lastly, to set limits on government guarantees. And those are well known to us, and I think an excellent idea if those areas could be improved on. If we move on to South Africa's economic growth performance over the last a decade and a half, we'll find that since 2012, our economic growth has averaged less than 1%. So only 0.8%, far below the level needed to address high levels of joblessness and poverty in our country. South Africa's limited public resources have been under significant strain for over a decade. And long-term growth is highly dependent on improving capacity in energy, improving capacity on freight rail and ports in our country, and also on continuing to reduce structural barriers to economic activity. Those are the things that will actually move the needle for the economic outlook of South Africa. If we look at private investment as a percentage of GDP, I've borrowed this from the IMF, from a report and analysis that they've done last year. Private investment in particular, in South Africa has fallen off a cliff since 2008. We have, however, not created an environment that attracts private investment, unfortunately. Being hostile to private sector involvement in the economy has certainly not helped. The private sector will invest in South Africa if there is concrete evidence that the state is able to put policies aside, or politics rather aside, and put us on a firmer fiscal path. And why are we not investing? Because we don't save. Speaking about savings, if we look at gross savings in South Africa over time, we find that, and this is important to get the causality right here, when it comes to investment and when it comes to savings, the savings fund investment, and investment stimulates growth, which grows prosperity. So which in turn raises the value of savings that have been invested, and so on. That is the cycle in the economy. But we are desperately low on savings. And part of the reason we see so little private investment is due to low savings. Corporates are the only ones that save in South Africa. Government and consumers are dissavers, and they have been for many decades. So one may ask, what determines how much cash corporates actually hold in South Africa. And it's interesting that Treasury notes your research from SARS and National Treasury's tax database between the period of 2010 to 2017 was investigated, and the findings from that research imply that implementing economic reforms to boost growth and aggregate demand in the economy will catalyze greater fixed investment by private firms. Furthermore, improvements in investor perceptions of government's ability to implement sound policies, policies that promote private sector development, will encourage private investment rather than firms retaining cash on their balance sheets. Greater private sector investment will support faster economic growth if we are somehow be able to unlock that. And as a percentage of GDP, corporate cash and liquidity holdings have not increased in essence since 2014. Cash holdings in South Africa were broadly a bit higher than in other emerging markets that came from that research. If we move on to tax takings, in this instance, provisional corporate income tax collectors or collections by sector over the first 10 months of the current fiscal year. Our tax revenue collection has deteriorated substantially over the past year due to the weaker economy. Earnings seems to have remained reasonably resilient, but corporate profits have declined significantly. Tax revenue has slowed in the current fiscal year as corporate collections have contracted by more than 14% fiscal year to date versus the same period compared to last year. The windfall tax gains from high commodity prices over the last 2 years have come to an end, unfortunately, leading to a sharp fall in mining tax revenue, as an example. Lower commodity prices, weaker global growth, increased power cuts in the form of load shedding, operational problems at our ports and rail have weighed heavily on the mining industry. Recapitalization of state-owned companies. The SOE bailouts has drained our fiscus. Eskom has dominated these bailouts. They have received more than 241 billion rand in fiscal support over the period as illustrated on the chart. The most concerning part is that the rapid injections had little to no impact on the actual service offerings. For example, South African Airways has received more than 48 billion rand over 6 years and still went into business rescue. So government do say that they have been working to reduce this, but reforms are slow and they would appear to be unenthusiastic. I think more importantly, the changes to date do not deal with the core challenges facing these institutions. And it is a rather slow and to be honest, a frustrating process. One can parallel it to continental drift, which I think is actually faster than what reforms are taking place in South Africa. If we look at the debt service costs that we bear in South Africa as a share of the main budget revenue over the last decade or so, we've seen rapid growth in debt service costs, and this in essence chokes the economy and also the public finances. Government certainly is aiming to stay the course, to narrow the budget deficit and to sort of stabilize debt. They've been very vocal about that yesterday in the speech. This year, for the first time since the fiscal year of 2008 and 2009, government will aim to achieve a primary budget surplus. I'm going to say this again because it sounds too good to be true. This year, for the first time since 2008 fiscal year, government will achieve a primary budget surplus. That is before interest on debt is accounted for. This is a promise, and it would be great if it is in fact achieved. If it is in fact achieved, but it does not remove the massive debt load that we've accumulated over the last decade and a half, and that debt load is still a noose around our neck, and unfortunately continues to remain. If we then progress to debt service costs and we compare it to some of our peers over time, we see from the chart our debt service costs are high compared to our peers as a percentage of tax revenue. This is due not only because of our level of interest rates, which of course has increased. Many other countries' levels have increased as well, but also because of the quantum of the debt pile, the stock of debt on which we actually pay interest these days, and how that is racked up over time. Gross debt to GDP and the outlook of this ratio. Few ratios are as volatile as our projected debt to GDP ratio. Our GDP is not growing at a pace that can keep up with our debt load. So our debt GDP ratio will continue to climb until we become sensible with regards to spending. If we cannot grow, we cannot spend. Or I should say, that should be the rule, and not to leverage the pots of gold to address our borrowing habits to make our debt servicing more affordable. Now, speaking of which, let's look at the so-called GFECRA, the Gold and Foreign Exchange Contingency Reserve Account, which is managed on behalf of National Treasury by the Reserve Bank. It's surprising how quickly there has been an apparent meeting of the minds between the National Treasury and the Reserve Bank on a credible way of how to tap the GFECRA. The change in the treatment of GFECRA is called reform in the budget yesterday. I warn, however, that this is not free money. With such a terrible fiscal discipline track record, it sets a horrible example in my mind. In essence, this is a well-qualified quasi-grab, a raid on the SARB, in inverted commas. The merits of tapping GFECRA will be debated at length, and markets will have their say in the end. National Treasury says that these extra funds are only for the purpose of reducing the need to go to the bond markets for debt that comes at a considerably higher cost. The risk, of course, is that should the currency appreciate significantly, this could leave the SARB, and therefore by extension National Treasury, in an expensive bind. Now, there are some announcements that they made yesterday which will prevent that, and I'll go through that. So government's gross borrowing requirement is projected to decrease mainly by the GFECRA settlement amount of 150 billion rands over the medium term, over the next 3 years. Government will receive distributions of 100 billion rand in the next fiscal year, and then 25 billion rand in each of the following 2 years after that. So this will reduce domestic market financing requirements, as well as the growth of debt stock and our debt service costs. Realizing any FX gains would be risky because it would require selling part of the reserves, which have taken years to build up. But again, there's been an announcement to prevent that from happening, which is good. Withdrawals from the GFECRA could or should come with credible conditions attached. And it appears that this has been the case if we look at some of the details that has been released yesterday. I do, however, want to urge a caution here, and we should exercise caution. Our reserves are there to protect us from international crisis and to maintain our credibility in the international financial system. It could certainly lower our borrowing costs if we start tapping it, and our hunger for borrowing in the short to medium term. But if we do not change our ways and restore fiscal discipline, it is simply throwing good money after bad in my mind. Significant economic and structural economic reforms will cost much less to implement and will do far more for economic growth. So state-owned enterprises, for instance, cannot, in my mind, or should not receive more public money bailouts without credible reforms being implemented first. The debt that we've built up in the past is in a large part due to that. So now we are using reserves in order to pay that off. So the fiscal performance of government has been a material risk to South Africa, and at times it has in fact damaged South Africa's investment case. So the rapid deterioration of the fiscal position during the Zuma years triggered fears back then that we were on a terminal path to bankruptcy. So if the new agreement stipulates that the GFECRA funds be used only to pay large one-off bond redemptions or buybacks, as opposed to fueling permanent consumption expenditure, then the markets, I think, would certainly cheer. If we look at Jafekra or the values over time, just a quick recap, Jafekra captures valuation gains on our FX reserves. So currently, those gains or those losses are not settled, but they are in fact reflected as assets or liabilities on the financial statements of the Treasury and of the SARB. So as the rand is depreciated against the dollar, the value of these holdings have actually increased in rand terms. Our Jafekra balance, to just put it into perspective, has grown from less than 2 billion rand in 2006 to more than 500 billion last month. So under the existing practice, these balances do not qualify for settlement. But Jafekra helps, in essence, to insulate the SARB's P&L from currency swings, since its valuation losses are not charged to National Treasury. However, the account is now larger than any plausible losses on foreign exchange reserves from rand depreciation. Or so National Treasury would like us to believe, and I'm going to tell you about the bucket system just now. Moreover, the system that we currently have had up until now is rather unusual. Other countries typically account for similar valuation gains in a rather different way. And this makes the SARB a little bit of an outlier among other central banks for the size of its liability to government. So this new proposed settlement agreement is to be formalized between National Treasury and the Reserve Bank, and it will establish a new framework of how to deal with it. The effect of which will be to reduce government borrowing. These adjustments will take South Africa closer to our peer norms. It's fascinating how this comparison was made. We want to be like our peers when it comes to this, but not when it comes to other things, but nevertheless. So the agreement will allocate funds across 3 buckets. The first bucket, Jafekra, will retain sufficient funds to absorb the exchange rate swings. And failure to do so would create an obligation to National Treasury to cover, exchange rate losses. Once this arrangement has been fulfilled, funds will be distributed to the second bucket, which is the SARB contingency reserve, to ensure the SARB's solvency remain in place and healthy. And then lastly, once the first 2 obligations, the first 2 buckets have been settled, funds will be distributed to National Treasury. So those are the preliminary guidance that we received in the speech yesterday of how this new system will actually function when it comes to the reserves and tapping them. 4 principles have been shared by Treasury yesterday, by the Minister, in terms of the Jafekra reforms. The first one is that the SARB policy solvency should not be undermined by any Jafekra distribution. That's a good thing. There should be no sales of FX reserves to realize any Jafekra gains. If such reserves are below estimated adequacy levels, which is wise to do. There should be no distribution of unrealized Jafekra balances that could plausibly be unwound by future rand appreciation. Again, that is made provision for, which is sound and prudent. And then lastly, any Jafekra distribution should be governed by a framework that rules out any ad hoc decisions. So it should also be public to ensure transparency, and should be used to reduce government borrowing only. So it would appear, if you look at this holistically, that a lasting mechanism has been devised between National Treasury and the Reserve Bank, and that there is no free money being created, let's say, willy-nilly via this, and that would never be, and that there would never be any ad hoc distributions, which is a good thing. It's a good thing, of course, because the sound of printing presses has given people headaches of monumental proportions throughout history. And what we don't want to happen over here is for this to become a new printing press. In its current form, with not all the details that we would like, it appears reasonably okay. The devil is in the detail and in what is going to happen over the next few months. Lastly, I want to mention an interesting note that was published by Treasury yesterday, and it deals with the economic impact of government spending. And they talk about fiscal multipliers, which are a measure of the impact of government spending and tax decisions on the GDP of the country. And they offer important insights into the performance of fiscal policy. So in South Africa, the impact of these multipliers has declined over time. National Treasury's internal estimates confirm that the fiscal multiplier is in fact below 1. So this means higher government spending has not been contributing to higher economic growth. This is a big thing to say, and it's a big thing to admit. This is mainly due to how the accumulation of debt by government has actually crowded out private investment by raising interest rates. So it also points to the importance of the composition of government spending over the last while. So higher spending on capital investment leads to higher growth in the long term. But consumption spending entrenches deficits and debt without stronger long-term growth. So there are 4 explanations that have emerged for these low fiscal multipliers. The first one yesterday by the minister is that unsustainable spending increases do not boost economic growth because higher debt service costs actually crowd out important economic and social expenditure. It's worrying that it's true, but it is. The second one is the efficiency of government spending is weak due in particular to poor governance in municipalities and state-owned companies. Thirdly is that structural constraints, such as the lack of reliable electricity and logistic challenges, mean that government spending fails to promote and facilitate private sector participation and investment, as we've seen from those levels. And then fourthly, tax increases to fund higher government spending can certainly harm economic growth in the immediate future. So in essence, if we put all of that in our pipe and smoke it, stopped senseless spending to try and make an impact on the economy, SA would be a better place with a smaller level of government expenditure overall, and possibly a far more efficient place at the same time. And then lastly, to conclude, perhaps a few words about the fiscal anchor. It is disappointing to not see strict fiscal rules being implemented, or at least the announcement thereof yesterday. But instead, turn to our reserves pot and talk up its leverage because of its size in the economy, and how it's a good thing that we can in fact use it. We should be careful to see this for what it actually is. This is not progress, it is kicking the can down the road. I think a fiercely contested election later this year may kick our democracy into action to hopefully safeguard how much debt we are able to take on in future. Several ways of saying this. One way would be to say no country can progress if its politics is more profitable than its industries. In a country where those in government are richer than entrepreneurs, they manufacture poverty, and we've had a little bit of that. Well, not a little, we've had a lot of that over the last decade or so. So last word from my side. I think if you look at this picture, it's not all bad news. There certainly is hope, but in the sense that our problems are man-made, therefore they can be solved by man, perhaps just not the same men that caused the problems in the first instance. So Mike, with that, I want to conclude and hand over back to you. Thank you.
Thanks, Francois. That is definitely insightful. Thank you very much for the presentation. I have a couple of questions, if you don't mind. I think the first one is just in respect of South Africa's debt problem. Do you think the ministers dealt with South Africa's debt problem in the budget?
Mike, to be honest with you, no. We are going to tap into the JFECRA. We are going to repay expensive debt, but it is funds for a rainy day to ensure our global financial stability, since we are a small but very open economy. So we only tap into a small portion of the JFECRA, but we still intend to use it. We have no guarantees new debt will not be taken on to bail out SOEs in future. And the budget is very silent on urgent reforms to unlock GDP growth and to prevent future SOE bailouts. So I don't think we've dealt with the debt problem as well as we probably could have, Mike.
Thanks, Francois. And then the fiscal anchor, in your opinion, did we get any new fiscal rules to act as a fiscal anchor?
Again, unfortunately, no. But we did receive another promise that it will follow. So, as I mentioned, we basically kicked the can down the road. I think a good way to indicate that we are serious about fiscal consolidation is to implement a new fiscal anchor. And we've had lots of talk about that, especially before, well, hopefully what is going to be a heavily contested election. Ideal legislation would probably stipulate that the debt to GDP ratio not exceed, let's say, about 60%, which can be, made out to be sort of a gold standard for emerging markets. I know the world is in a very difficult place at the moment when it comes to that, but we are likely to reach, close to 80% over the medium term. Yesterday, the rise is down a little bit, but we're far away from 60%. So it's unfortunate that we have not.
Maybe a little bit of a difficult question, a bit of speculation. How do you think international rating agencies will respond to this budget?
So what they look for, and what that in essence measures, is a sovereign's willingness and ability to repay its debt. And is it improving or is it deteriorating? Our budget promises, the big question is to ask, is our budget promises actually turning into deliverables? And we need to restore our fiscal credibility before we can expect an improvement in our credit ratings, Mike. A lack of structural economic reforms while we leverage the reserves is in my mind, not the best plan. We constantly, sensitive to that we don't use too many of the reserves if you look at yesterday's speech, but we can just as well bring about structural economic reforms and get the economy to grow at a far more rapid pace. And that will improve our ability and willingness to actually settle our future obligations in domestic and in hard currency. So I think we need to pay closer attention to that going forward, Mike.
And then I think there's one last question that came from the floor, and that's in regards to tapping into the reserves and whether there's actually precedent globally, other countries that have actually done that, and what the subsequent impact has been on the economy, etc.
So the difference between what we've been doing over the last 20 years in South Africa versus what other countries have been doing, they haven't built up the large de facto equivalent compared to the size of the economy than what we have. But what they've done is they've sort of dealt with the profits and the losses on a year-by-year basis. So we haven't done anything, but there wasn't much to do in 2006 when it was only 1.8 billion rand in value. Today it's 500, so it's a very attractive pot. I don't want to say that we should follow the other countries in this instance because they're doing it, we need to do it as well. If we followed what all our emerging market peers are doing, we wouldn't be having this massive debt problem in the first instance. So we can't say we want to do that because they do that, but we're so selective in terms of what we want to do compared to what others are doing. We should take the good and the bad then. And the good would be, make ourselves significantly more competitive at the international level, especially in an economy that can only grow really via increasing net exports. And this is not the case with load shedding. This is not the case with going from pit to port and then through the port in terms of mining, for instance. So yeah, there's that.
Perfect. Thanks, Francois. Thanks for your insights. Very, very helpful in unpacking what is complex, many moving parts in the South African economy. Thank you very much for your time.
Pleasure.
Okay, we'll be moving on now to the tax proposals. And there were, I guess for an election year and as a tax practitioner, there were quite a number of proposals that have come through, especially around the Annexure C items. But we won't delve into too much detail into those areas now. My colleagues will, but maybe just moving on to what the Minister of Finance said. And it's always quite nice just to see where the taxes would come from in 2024, 2025, as it would be in any other fiscal year. And as you can see from this, the massive balance is coming from personal income tax, so 739 billion, more or less estimated that they will collect for 2024, 2025. And that's in line, and that notwithstanding the fact that personal income tax rates are not going to be increased, the brackets aren't going to be increased, but there's something called fiscal drag or bracket creep, as the case may be. So if you're getting an increase, you might end up paying higher taxes. So the distribution of where the taxes are going to come from pretty much in line with prior years. If we move over to the next slide, the Minister indicated that the 2024-2025 proposals will raise approximately 15 billion rand of revenue. As I already alluded to, there's no rate increases or rebate changes, including medical credits, so everything remains the same. Unfortunately, for individuals getting a massive bonus or an increase, you're going to find yourself in a position that you pay higher taxes. So the numbers indicated 15 billion is probably a little bit higher than 15 billion, less certain adjustments. The other area that they're going to focus on is, unfortunately, on alcohol and tobacco, where they are going to increase by higher than inflation percentages, on alcohol and tobacco items. And then also in the 15 billion mix is the two-part retirement system, and the fact that people will be able to withdraw funds from the system in September 2024. And I suppose there's tax on that they'll collect. And then, quite interestingly, the implementation of global minimum corporate tax. So that's the OECD Pillar 2 initiatives, which take effect on 1 January 2024. But delving a little into the detail, maybe we can start with some of the corporate tax proposals. And I'm going to ask my colleague, Roné to take us through those.
Thank you, Mike, and good morning, everyone. Mike mentioned the electric and hydrogen-powered vehicle manufacturing incentive. That's quite an interesting incentive that has been announced, which will take the form of 150% investment allowance in the first year for qualifying spend on production capacity for electric and hydrogen-powered vehicles. This allowance will be available from 1 March 2026. So there's 2 years to plan for this. And the estimated tax expenditure for that single year in which it will be available is 500 million rand. There's also an interesting incentive for infrastructure projects. Government indicated that they will investigate the feasibility of a flow-through tax treatment for certain infrastructure projects. It's indicated that the flow-through tax treatment will be similar to trusts and other investment vehicles of such a nature. Now, that would presumably mean that where the returns on the project are distributed or vested to the investors, it will be taxed directly in the hands of the investors and not in the project entity. And that would certainly boost interest in investing in infrastructure projects. What remains to be seen is what type of projects would qualify for such a favorable tax treatment. If we move on to energy, a burning topic in this country, last year we saw some temporary incentives being introduced to incentivize both individuals for domestic use and business to spend on renewable energy assets so as to take load off the grid. And this took the form of Section 6C of the Income Tax Act, which was introduced to provide for a tax credit for individuals installing solar panels for residential use. That incentive will end at the end of this month, 29 February 2024, and there hasn't been any indication that this will be extended. For business, last year, then there was an announcement of 125% allowance in respect to the cost of renewable energy assets, and that allowance contained in Section 12BA will continue until the end of next year, February, so the 28th February 2025. Again, no indication that this temporary incentive will be extended. However, the permanent renewable energy allowance that's contained in Section 12B of the Income Tax Act will be extended in certain areas. That allowance is already favorable compared to other allowances for assets, and in general allows for a deduction over 3 years, 50%, 30%, 20% of the cost of the renewable assets. But where it's a solar photovoltaic energy generation up to 1 megawatt, the allowance is 100% in the year in which the asset is brought into use. Government will consider increasing the 1 megawatt generation threshold to also allow for 100% deduction of the cost of the asset where the energy generation is in excess of this threshold. In addition, currently, where the renewable energy assets are leased to others, there are certain limitations on the allowances, and this will be relooked at and might be relaxed. Moving on to an anti-avoidance provision, Section 8EA, and so-called third-party backed shares. Dividends, which are usually exempt from income tax and exempt from dividends tax, would, in respect of a third-party backed share, be subject to tax in the hands of the holder of the share. And this is unless the share has been issued for a qualifying purpose. A third-party backed share would be a share where a third party, other than the company that issued the share, backs the performance of the issuer in terms of the share. The qualifying purpose definition includes preference share funding that were issued for purposes of acquiring equity shares in an operating company. And as part of the 2023 legislative changes, last year's changes, on disposal of equity shares, that qualifying purpose will fall away, and the dividends on the preference shares will become taxable. There are some exceptions to that rule, and already introduced as part of the 2023 legislation. The one is where the shares in the operating company are shares listed on a South African exchange, and they are substituted for other shares listed on a South African exchange. That exclusion will be extended to also substitution of listed shares on a foreign exchange. Also, the exclusion will apply where the shares in the operating company, when it's disposed of, the proceeds are used to redeem the preference shares within 90 days after the disposal of the shares in the operating company. Now, the existing legislation only allows for use of the proceeds to settle the issue price of the preference shares or the third-party backed shares, and not dividends or foreign dividends or interest, and that will be extended to use of the proceeds on that basis. And then a final change to Section 80A, an expansion to its application. With regard to the right to enforce these third-party backed elements against the holder will also be extended to not only tax dividends where the holder has an enforcement right against a third party, but also where a connected person in relation to that preference shareholder or third-party backed shareholder has an enforcement right. Another area where we've seen consistently almost every year changes is the limitation on the deduction of interest. We have two sets of rules. On the one hand, we have a set of rules that apply where debt is used to buy shares or to buy assets in terms of tax rollover relief, section 45 or 47. On the other hand, we have a set of rules that apply where debt is obtained from a related party and that creditor is not taxed on interest income in South Africa. Now, there has been a lot of focus on the latter set of rules, the rules that apply to related party debt, typically cross-border debt, where the creditor is a foreign party not subject to tax in South Africa, because that erodes the tax base. But the same focus is not being given to the first set of rules dealing with debt used to buy shares or buy assets through rollover relief. And it has been announced that those rules contained in section 23N for November will be looked at and will be aligned to tweak it to be closer to the set of rules in section 23M for Mike, dealing with cross-border debt. A further change announced on the limitations on the deduction of interest is a very welcoming point, and this is in respect of cross-border the debt owing to a related party that's not subject to tax. This was aimed, as I said, to really protect the tax base where interest is paid to foreigners and the interest is deducted. But it also applies to local exempt entities who advance debt to related parties, for example, pension funds. And amendments may be introduced to address this unintended impact on local exempt investors, which loan money to related parties. Contributed tax capital, again, an area that we often see changes. Contributed tax capital is a concept that reflects, for tax purposes, the consideration that a company has received in respect of the issue of shares. And this is a key concept where there are foreign shareholders, because a foreign shareholder can provide capital, can provide consideration for the issue of shares, and the company can return that capital to the foreign shareholder with a dividends tax-free. So it would only be profits over and above the capital that will be subject to the South African withholding tax. However, there are limitations in Section 8G of the Income Tax Act, and that limit was brought in to cover a very, very specific type of transaction where taxpayers were introducing a new holding company in South Africa purely to create contributed tax capital, so as to have the ability to extract more funds from South Africa by way of a capital return that's not subject to dividends tax. Unfortunately, the Section 8G has a lot of unintended consequences. For example, where a foreigner subscribes for equity in a South African holding company, and that holding company buys out a BE shareholder, which often needs to happen, it will be caught by the limitations. Or where that holding company uses the money to, in turn, subscribe for shares in a subsidiary to fund the subsidiary, it will be caught by Section 8G limitation. It has been announced that government will look into these inadvertent consequences and that we can expect refinements to Section 8G. Very good news. And then also there has been last year an announcement, Robyn might touch on it as well, where the contributed tax capital is reflected in a foreign currency. Rules will be provided as how to translate that into ZAR, and these rules will be postponed until January 2025. to make sure that there has been enough consultation to discuss. The corporate reorganization rules, those are contained in section 41 to 47 that provides tax relief in a South African, for transactions in a South African group context. A very welcoming announcement is the clarification of the degrouping rule in section 45. Now, where assets have been transferred on a tax-neutral basis between companies within the same group of companies, in terms of a section 45 intra-group transaction, a 6-year degrouping rule must be observed. In order not to trigger the degrouping charge, the following structures must be maintained for a period of 6 years after the acquisition. The transferee company and the transferor company must remain part of the same group, or the transferee company must remain part of the same group as any controlling group company of the transferor company. And that has sparked debate as to whether the degrouping rule may have unintended consequences where any of these control group companies above the transferor and transferee leaves the group, whether that can cause a degrouping and the degrouping tax charge. It is proposed that changes will be made to the degrouping rules to clarify that a change in the shareholding higher up in the chain of the corporate ladder will not trigger the degrouping charge. 2 more changes to corporate reorganization rules on the next page. The first being that the tax rollover relief provisions of section 42 to 47 do not override the CGT implications of a so-called value shifting arrangement. A value shifting arrangement is where a shareholder in a company's, the value of the interest of a shareholder in a company reduces, otherwise than by way of selling shares, and the value of a connected person either increases or a connected person acquires an interest in a company. That can cause a deemed CGT event, and the shareholder whose interest reduces will be taxed in terms of the CGT legislation. A change is proposed that the definition of value shifting arrangement will be amended such that where tax rollover relief provisions are used, and there's a shift in value in the underlying subsidiaries, but the value of the sum of the parts remain the same, that will not trigger the value shifting. And then finally, for amalgamation transactions, that is relief in terms of section 44 of the Income Tax Act. There is some discrepancies and contradictory references between the definition that allows for the amalgamation of assets into a controlled foreign company and the exclusions in the amalgamation provisions that denies tax rollover relief where the company that acquires the assets, so the company into whom the amalgamation is performed, is not a tax resident. Apart from the corporate tax provisions that I've mentioned thus far, there are 2 other maybe noteworthy changes. The one is relaxing the assessed loss restrictions. The general rule is that only 80% of a company's income can be set off against an assessed loss. So that means that 20% of income will always, taxable income will always be taxed. This will be relaxed where the company is in liquidation, deregistration, or being wound up. That company will be allowed to use its full assessed loss before its corporate existence is finally terminated. And then a change to the definition of connected person, also a welcoming change this. There are a number of provisions in the Income Tax Act that would tax connected persons differently from the terms of the transaction as agreed between the parties to prevent tax avoidance. Now, the definition of connected persons when it comes to partnerships calls all partners of a partnership to be connected persons, and all connected persons of those connected persons are connected. And this has unintended consequences for limited partners in an uncommon deed partnership. We often find this in private equity. So government is proposing that the definition of connected person will be tempered to not have such a severe impact where the limited partner is a so-called qualifying investor. Qualifying investor is a definition that's already contained in Section 1 of our Income Tax Act. So they're going to latch onto that definition for purposes of changing the connected person relationship. And it includes, for example, partners in a partnership that does not participate in the effective management of the partnership. So that makes sense. So the limited partner has no say on with regard to the terms of the transactions, and therefore shouldn't be penalized from a tax perspective. Not to delve into this in great detail, just to mention that the tax proposals there are some tax proposals impacting the financial services sector, the banking and insurance, and these proposals are all aimed at further aligning the tax treatment and of these specialized industries to the accounting recognition of assets and income and expenses.
Thanks, Roné. Just maybe a question from my side. On balance, in your opinion, the proposed amendments to corporate tax legislation, good for taxpayers, bad for taxpayers?
It is overall good news. Wonderful good news, yes.
That was my sense.
So now we wait to see the detail in the draft bill.
Correct. And I think what's also nice for me is that our interactions with the National Treasury last year around the tax bills and the Annexure C submissions have actually paid dividends. So it seems that they are willing to listen, especially where we're looking for clarification. We're not seeking benefits. And I think a lot of these amendments are just clarification points where we've been uncertain in practice. Would you agree with that?
Absolutely.
Perfect. Thanks, Roné. And I think, the bigger changes maybe are on the international tax side. We've all been waiting for Pillar 2, and for people like me, I thought maybe that's 2-3 years away, but I must have missed the memo, but it seems like it's 1 January 2024, and then there's some significant exchange control points as well. So Robyn, Berger, if you want to take us through those points. Thanks, Roné.
Thanks, Mark. Thanks, Mark, and good morning to the audience. Many of you will remember that in 2020 budget speech, sweeping reforms were announced around the exchange control regime, whereby it was proposed that everything would be possible except for 1 or 2 arrangements that would require some level of approval that's, that would remain. And then, there was this kind of deathly silence for a while where the only thing we really saw come through was the relaxation of the loops. And even that has been met with some resistance and some confusion in the market. And it's unclear at this point in terms of what loop arrangements are or are not allowed. So overall, the last, 4 years have been a little bit disappointing when it comes to what we were hoping to see within the context of exchange controls. And 4 years later, after searching like lunatics yesterday, I don't know if any of you saw Annexure E, it was kind of hidden, but we found it, and we have finally have some meaningful, what I would call relaxations, but hesitantly relaxations, because the law still sits, the law still remains. But what's nice is that they're saying that authorized dealers are being given greater authority and wider powers in terms of what they can approve, as opposed to having to go to the Reserve Bank. Now, typically when you go to your authorized dealer, it takes a few days to get your applications approved, maybe a week. But if you go through to the Reserve Bank, that's about a 4 to 6 week lead time, depending on where we are. If they're busy with things like budgets, then it could be up to 8 weeks to get a response. So having to deal with an authorized dealer is certainly a much quicker process, but we do expect that this would cause chaos for a while in the market, which we've seen in the past, because the more Reserve Bank places these responsibilities in the hands of authorized dealers, the more exposed we are to different views, to different approaches, to different risk profiling, and to different risk processes. And this often leaves applicants or parties wanting to transact cross-border even less certainty than they had before when it had to go to the Reserve Bank. It does tend to settle after a while because, you know, the ADs tend to huddle together. They engage with SARB a lot. They engage with each other a lot on these issues, wanting to achieve consistency. You know, you're not allowed to go to one AD shopping for a better opinion than another AD. But so it does take time, and hopefully that won't cause too much friction in the market till we get there. Next slide, please. So these are some of the bigger, you know, relaxations that we saw, whereby authorized dealers can now actually approve foreign listings or of South African companies or subsidiaries of South African companies to raise up to 5 billion offshore. I mean, anything regarding a foreign listing to raise capital would have always had to have gone to the Reserve Bank historically, but it's only for parties that are operating in the technology, media, telecoms, exploration, other research and development fields. So if you're not in those fields, or if you're above the 5 billion, you would still have to go to SARB. And if you're going to do things like share swaps, or if you're going to want to transfer intellectual property out of South Africa, you would still need to go back to the Reserve Bank. So it's quite limited. It is quite limited, but at the same time, there is some good news there around, you know, less red tape and having to go to SARB in certain instances. The other thing that's really welcome is, sorry, just going back a slide, is the relaxation around ADs being permitted to approve private equity firms wanting to invest offshore up to 5 billion. One of the difficulties we have with private equity firms is very often they're arranged as partnerships, and very often we have difficulty with SARB agreeing to a partnership making an offshore investment as opposed to each of the individual partners. I'm waiting for the SARB circular to come out to better understand what this means, but I'm really hoping that it means that partnerships that are formed in the context of private equity, where they are registered with the Financial Sector Conduct Authority, will now be able to make these investments, and we won't have to get each individual partner to make an application under the foreign direct investment rules. Thank you. You can move on to the next slide. Other things that you know, and the one that I've highlighted there in red is obviously the one that's the most exciting, certainly for me. But other rules that they've relaxed, where they've given more flexibility and more powers to the AD, is arrangements around customer foreign currency accounts, CFC accounts, not to be confused with controlled foreign companies, which we'll get to just now, but customer foreign currency accounts, whereby these are accounts that South Africans can actually operate with South African banks in currencies other than rand under certain circumstances. So it's not a foreign bank account, it's a bank account held with a South African bank, but it's in, could be dollars, pounds, whatever it is you want to transact in, right? And typically, these are very heavily scrutinized. There's only very limited transactions that we can actually conduct through a CFC account. And very often, most of these things have to go to SARB for approval. And here we've seen some significant relaxation. For example, and this is one that I deal with quite extensively because we're working on quite a number of investment projects, whether it be in the renewable energy space or the data center space, where A lot of the goods are imported from foreign suppliers, and you will have a local parties actually selling it to you, and they would like to be paid by you in foreign currency, on the understanding that they would then hedge themselves against the cost of having to pay their offshore supplier. And historically, we would have had to all go to the Reserve Bank for permission for that to happen. And now what they're saying is that, you know, a party can actually make a payment from one CFC account to another CFC account to the extent of the imported product. And local agents of exporters can also make payments to their exporter customers without the SARB approval in foreign currency. So those are really nice relaxations, and, you know, a lot of reduced red tape there. ADs will also, authorized dealers would also be permitted to process all related party current account payments, provided suitable transfer pricing documentation is reviewed that confirms the arm's length nature of the relevant agreements, and that's without SARB approval. This is a huge shift from what we've seen in the past. I think we need to wait and see how the manual is updated around this, how far this will go. Will it include interest payments on loans? Will it include management fees? Will it include royalties? Of course, I don't think an in-house prepared transfer pricing document would suffice. I would imagine it would have to be from a third-party transfer pricing specialist. And I think that without that, you know, third-party documentation, the odds are you're going to have to go to SARB if they'll entertain it at all. So it's kind of placing this obligation to police what's moving in and out of the country on third-party transfer pricing specialists, removing it effectively from the AD in a way, and removing it effectively from SARB in a way, because, you know, they're saying if that third party is attesting to the fact that this is arm's length, then, you know, SARB must be happy. And I suppose if things were to be found to be wrong, that could knock on the door of whoever it is that signed off on that. Then the other thing that I found quite interesting is that the Minister of Finance also announced that National Treasury, SARB, the Prudential Authority, the Financial Sector Conduct Authority, they're all huddling and they're deciding, you know, what are the impact of all the relaxations so far, and what should further be implemented, and how fast the pace at which further relaxations, if any, should be implemented. And it kind of suggests that there have been relaxations implemented in order for them to assess those, other than the ones announced now. And I'm a little confused, but it's interesting to see what comes of that, because I don't feel there have been really meaningful relaxations at this stage, but that's just my view. The other thing, which is not really exchange control related per se, but certainly relevant to those of you that operate in the cross-border payment space, on the low value payment systems, is that they recognize that the cost of these transfers is really prohibitive and really, you know, inefficient at this stage. And the reason being, of course, is that because we're so heavily reliant on cash in that sector, where you have usually, you know, your middle class to lower class, to lower income earners, I should say, where they want to send their money to family members, whether they live, you know, in Lesotho or Mozambique or Zimbabwe or wherever it is. And a lot of this is cash driven, and cash handling fees are very expensive. They estimate that it's costing around 7% to run these processes, these transactions, where they should probably be at around 3%. So the idea is certainly to make sure that people in you know, outer-lying regions can have access to electronic you know, solutions here. Internet access, of course, would be key to that. Mobile phone devices, I would imagine, or some other form of device that is a smartphone, I think would also have to be key to that. I think it's not an easy project to undertake, but they're certainly going to start rolling it out in certain areas. This includes also making it possible, because, you know, less and less people in certain areas carry cash, while, you know, you could come across a car guard or whoever it is that you want to tip, and then you know, I personally have experienced this, where you now feel bad because you don't carry cash on you and you only have a card. So they're looking for solutions as well around, you know, tipping people who you know, don't ordinarily, or tipping by people who don't ordinarily carry cash, for people who, you know, are desperate for cash. So lots of initiatives that are taking place, very interesting stuff in the payment space. And it will be very interesting to see how this all plays out and what alternative means are put in place and how they get those costs down. Thank you. Next slide. Okay, so on the international tax side, on the tax front, I think obviously the biggest news of the day is the introduction of the global minimum tax, the Pillar 2 initiative. And I think what was even more surprising is the 1 January 2024 start date for years of assessment. I think it's starting on or after that date, if I'm not mistaken. Yes, beginning on or after that date. And they have basically released yesterday draft Global Minimum Tax Bill, the draft Global Minimum Tax Administration Act, and an explanatory memorandum that supports it. Okay, comments on all those documents are due by the 31st of March, so it's not very much time, especially on legislation that you're already meant to be enacting. And I suppose, you know, in all fairness, you could argue they did warn us last year that it would come as part of the 2024 tax proposals. And because of the way in which this tax works, whereby it only impacts multinational organizations with 750 million euro in consolidated revenue, we're probably talking with, you know, very few companies in South Africa that are actually going to be subject to the tax. So it's really your large multinationals, and they've been engaging with SARB on this, I would imagine, for SARS on this for some time now. And so it might be difficult for them to argue that this is effectively retrospective legislation, but time will tell how the comments come through and how the inputs come through as to whether. I'm certainly hoping we can defer this for at least another year. There's 2 measures that are enacted to effect this change. There's an income inclusion rule. There's a domestic minimum top-up tax. These laws are so complex. They basically have the effect that if you're earning revenues anywhere in the world and you're not paying a minimum tax of at least 15% on those revenues, then unfortunately you're going to be triggering at least a 15% tax on those going forward. And Treasury indicated that by they are planning to collect, or they're optimistic to collect, about 8 billion in taxes for the 26-27 year. And it will certainly be interesting to see if they do achieve that. Just remembering that we do have controlled foreign company legislation in South Africa, which is already applicable. It's already quite onerous to comply with. Now these large multinationals need to comply with these rules as well, which, you know, part of me really does feel sorry for them on the compliance costs here. But there are, you know, rules in place that prevent double taxation from the one to the other. Thank you. If we could move to the next slide. Right, then some further cross-border, you know, changes that were proposed. The one is really, you know, quite a simple thing where they introduced an exemption for foreign returns of capital that are made to South African shareholders if you hold at least 10% of the equity shares of the foreign company. This exemption's been there for ages. They just kind of narrowed it where you had to hold the shares for at least 18 months. But what they forgot to say is that you could have held it within a whole group over a period of 18 months. So it didn't have to be that specific shareholder who was the holder for 18 months. And so they're just going to update it to include that provision. 6 Quad also currently allows, if you earn a foreign dividend that's partially exempt under the 10B3 rules, that you can claim your full foreign tax credit on the dividend, even though part of the dividend is exempt. So you would pay your withholding tax, let's say, on 100% of the dividend. You're only taxed on a portion of it, but yet you get to claim 100% of the foreign tax credit to the extent it's allowable under our law. And they're just going to align the capital gains tax regime with that, because, you know, we have an inclusion rate for capital gains. We don't tax the whole capital gain. Then there will also be some rules introduced to address our controlled foreign company laws and how 6 Quad works in terms of those. I don't want to get into that too much. But one of the things I do want to highlight is that there's certainly, in SARS's view, a mismatch between preference shares and arrangements whereby there's foreign loan funding. that the foreign loan funding is giving rise to forex losses, while the preference share is ignored for tax purposes because it's not an exchange item under 24I of the Act. And so their intention now is to reclassify the preference share as a exchange item under 24I and tax FX gains and losses on that. This would be the case where your accountants also choose to classify that pref share as debt. And it took me a while to understand where this could possibly, play a role. And Yasmeen actually pointed out to me, it's probably most likely on your back-to-back arrangements if you've lent from a foreign party and you've taken that cash that you've lent and used it in an offshore subsidiary, because it wouldn't make sense to be targeting South African preference shares, I would think, because those are ZAR denominated. What I would advise you here is really to go and look at your balance sheets and see if you do have any foreign currency preference shares and start to think about what the impact could be here on these provisions. Then for a long time, we've been addressing this issue with National Treasury that we have a problem with the way that 24I works when it comes to forex gains and losses on exchange items in pure holding companies that arguably don't trade. And the reason being that we can have a massive loss in 1 year and a massive gain in another year, and that loss doesn't carry forward because the entity is not trading, so it doesn't meet the requirements to carry it forward. And it looks like National Treasury have finally heard us, and some rules will be introduced to address that. Thank you.
Thanks, Robyn. There is a question from the floor, and I think it's going to be a difficult one to answer because I don't think we have the detail, but it's interesting to see that, from a transfer pricing perspective, you're not forced to keep documentation, but now for Reserve Bank purposes, as you mentioned, with AD payments, etc., they would want to see that. And I think the question from the floor is, do you believe, or do we know whether it's an annual exclusion? So you take your transfer pricing documents and you say, these are the regular payments I'm going to make, or do you think it's a transaction by transaction basis?
So I definitely think it's going to be per type of transaction, but I don't think you're going to necessarily have to renew it on an annual basis because, I think they will very much so rely on what are normal OECD transfer pricing practices. And we know that, transfer pricing documentation in some cases and in some industries, certainly it's appropriate to look at it annually, but in others it may not be, provided no circumstances relating to that transaction change materially. So I think that, at this point you would do well to start to engage with transfer pricing specialists and, start to look at what your transactions are and say, are these supported? Because most transfer pricing specialists would be well familiar with the kinds of letters that have to be issued in support of these applications to the Reserve Bank. And I don't think that that principle would change in any way here, although we are still waiting for final confirmation on circulars, but I don't see them stipulating that kind of level of detail. I think they really will rely on what is the norm in the market based on OECD.
Thanks, Robyn. And yep, there's another exchange control question, and the question is, will the authorized dealers now be able to approve payments of personnel costs, so an expat pool, that are recharged by the foreign connected party through a CFC account?
I would think they should be able to, but again, until we see the circulars and more detail around it, it's a little uncertain. And I also want to just remind you what I said earlier. There's going to be so much confusion in the market, I suspect. I don't hesitate to think that SARB has had a meeting with the ADs, given them some instructions and briefings around what was coming, but I still am anticipating a lot of confusion, and you might find things are still referred to SARB, even though you feel frustrated that they probably could have been approved by the AD. But until the ADs get comfortable on these arrangements and until they, feel that their risk profile is satisfied for the bank itself, because, they don't want to do things that could jeopardize their relationship with the Reserve Bank. They're simply agents of the Reserve Bank. So I do think we'll see some frustration.
Thanks, Robyn. Appreciate it. And yeah, we'll move on to the personal income taxes and other taxes. I think quite important, Yasmeen, we'll deal with that, given that the bulk of the tax collection will come from personal taxes.
Thanks, Mike. I feel driven to have a drink now. So if I could move my slides, it would help. There we go. Right, I'm showing my age. As Mike mentioned earlier on, the bulk of the current year fiscal increase of tax increases are going to come from personal taxes, and not from increasing any of the tax rates, but simply by not giving any relief for inflation. So you'll see on this table that the tax rates for the next year will be the same as the current, same tax brackets, same rebates, and so on. Fiscal drag is anticipated to raise about 16.3 billion rand. So it tells you, going into the budget speech, a lot of commentators and even Treasury said that they were 15 billion rand short. I think they had this in mind. I think it's a bit more palatable compared to a VAT rate increase that would have raised maybe a slightly more than this, simply because this is not regressive. The burden is more on your higher paid individuals. I think, and I think what's more palatable is that the fact that there's no increases is just going to be, realized as people, as employees and other individuals earn more money. So I think maybe a better choice from a policy perspective in terms of raising the additional revenue. With regard to tax rebates and thresholds, these remain exactly the same. But the one thing I want to pick up on the slide is the statistics as to who actually pays any tax. Now, one of the statistics that they've been tracking for at least the last 10 years is the number of individual taxpayers. At the moment, we've got about 14-point-something million taxpayers in the country, individual taxpayers. Only 7.4 million of them pay tax. Right? So it's 7.4 million individuals paying 738 billion rands in tax. That is a big chunk. Right? 48% of registered taxpayers, personal taxpayers, do not pay any tax because they're below the threshold. So our tax base is still far too small. We have a reliance on a relatively small pool of individual taxpayers in the country. Taxpayers earning more than about 1.5 million rand a year, there's only 198,000 of them, and they pay 32% of the personal tax bill. So it's a high incident on a relatively few taxpayers. And these, what I'm finding over the last few years, are quite mobile taxpayers as well. So we've seen quite a few exits. We personally assist quite a few people exiting the tax system here because of immigration and breaking tax residency and so on. So, hopefully in time, it doesn't erode this number too much. With regard to medical scheme credits, as Mike mentioned earlier on, there was no adjustment for inflation this year. I think that's more palatable than the other news that we were expecting, that it would be removed to fund the NHI, because that's the plan, that the medical scheme credits at some point will fall away and that money would be diverted to the NHI. So at least a silver lining. But not adjusting the credits for inflation is expected to increase an additional 1.9 billion rands in revenue. So it is significant. It's not a small number. With regard to the two-pot retirement system, this has been in discussion for many years now, and apparently last year they said it was going to come into effect. Now it's meant to come into effect on the 1st of September 2024. And, I think the basic system is pretty much the same. There's going to be a savings pot and it's going to be a retirement pot. And the savings pot is going to be accessible immediately. So on the 1st of September, members of pension funds and provident funds and so on will be able to access those savings. The expectation from Treasury is that many individuals will access it. So it sounds like Francois' Jeffectra thing that there's a pot that we want to access. So I think maybe government took a leaf out of this particular book. And the expectation is from the withdrawals that are going to happen from that savings pot, they expect to raise an additional 5 billion rand in revenue this year, a significant amount. But I think from the point of view of the man in the street, if you've got some money available and you're in distress, why not access it to relieve yourself now instead of waiting for later? So, it's perfectly understandable, but it'll be interesting to see what the impact is going to be on the retirement fund industry. Then with regard to employment, there have been a few proposals that have come through. The first is around the employment tax incentive. Now, in previous years, there were some amendments that were made to curb some abuse, particularly around the use of training institutions. So typically what would happen is an employer would contract with a training institution, and essentially pay for the training institution to train people and treat those people as employees for the purpose of employment time. But in effect, those employers never saw those employees. They were always just at the college or whatever it is. There was there were quite a few amendments to close down those loopholes over the last few years. We have a few taxpayers that we're dealing with where we're dealing with the legacy issues now of trying to argue with SARS that they are entitled to the ETI. But the further amendment that's proposed in the current year is to impose punitive measures for abusive behavior. So in the past, understatement penalties didn't really apply to the employment tax incentive. Last year, there was an amendment or a proposal to say that it would be extended, understatement penalties would be extended to employment tax incentive. This year, I'm not sure what additional punitive measures are being proposed. There's no further detail in the budget review. Then some good news for employers that employ learners and train these learners. The sunset date has been extended by 3 years to the 31st of March, 2027. The experience that we've had on the ground is that it's been quite effective in assisting employers to spend the money to train people. The one big beneficiary that we've seen has been in the automotive industry, where, as a result of large contracts, automotive component manufacturers have been able to use learnership allowances to be able to fund the training of the employees that they needed to employ. So this is good news. The National Treasury is planning to use the extended time period to evaluate the incentive and decide on its future. I think at the end of the day, it's been successful in upskilling employees and making them employable. So I suspect that come 3 years' time, we're going to see some form of learnership allowances still being retained. From a payroll perspective, I'm sure you must have seen in the media, not only from a payroll perspective, certainly from a VAT perspective as well, what SARS wants to move towards is almost like real-time reporting of taxes to SARS. So on the payroll side, the biannual reconciliation process is meant to be done away with. And on a monthly basis, employers are going to effectively reconcile their payrolls and submit that to SARS. And I think it's a similar thing on the VAT side as well. They really want to know real time what the VAT payments are going to be. They want to have access to, have further insight into, I would say, more the formal economy. Now, one of the amendments that are coming out from this ability or this move towards monthly payroll is if an employee has to refund a certain amount of remuneration to its employer. At the moment, you have to wait until your return has been assessed to be able to get your tax refund. Your employer is not able to give that money back to you by the payroll. So it puts the employee into quite a bind because effectively what they have to do is refund the gross amount that was paid to them, and only claim the tax deduction at a later stage. So I think the amendment for the current year is to allow for the deduction to happen by the payroll, which is, I think, a welcome change. Then with regard to trusts, so we see, the good news is that we still have trusts, right? They haven't taken it away. Certainly, there's been a consistent trend over the last few years to tighten the screws, and this year is no exception. The good thing is the rate remains unchanged at 45%. That's the rate at which trusts pay tax, and it's a flat rate. The amendment that's coming through this year is an additional amendment to Section 7C. And essentially, Section 7C of the Income Tax Act is a provision that provides for donations tax to apply where low interest or no interest loans are provided to trusts and, of course, to companies owned by trusts and so on. There is an exclusion in the Section 7C to say that where the transfer pricing rules apply, Section 7C does not apply. And there is a concern that, from a transfer pricing perspective, the arm's length interest could actually be less than the official rate of interest that may be applicable. So it seems like the amendment that's being proposed is to subject the differential to Section 7C of the Act. So if the official rate of interest is higher than the arm's length rate, that differential would still be subject to Section 7C. In looking at wealth taxes, these all remain the same. So I think that's good news. CGT rates, estate duty, donations tax, transfer duty, and STT all remain the same, no increases there. On the withholding tax front, no increases, no decreases either. So the dividend tax rate remains at 20%. The withholding tax on royalties and interest to non-residents remain at 15%. So on the VAT front is where we saw a lot of changes, far more than I've seen in recent years. And one, I suppose to be honest, quite unexpected because, it's an election year, and typically in an election year, you wouldn't think that National Treasury would be too keen to deal with too many technical amendments. But on the VAT front, you'll see from the next few slides, there's been quite a few amendments that have come through. The most notable amongst them are on this slide. The first one relating to the zero rating of fruit and vegetables. So currently, in terms of the regulations or the Schedule 2 of the VAT Act, fruit and vegetables are zero rated, provided they are not cooked or treated, except for preserving the fruit or vegetables in their natural state. Right? Now, according to the budget review, the amendment that what they are proposing is really a clarification. The zero rating does not apply to pre-cut or prepared fruit and vegetables. So your packaged stir fries, if someone's chopped up some cabbage or mango or strawberries or watermelon, effectively what they're saying is that the zero rating does not apply. Now, I can just imagine the impact on Woolworths business. But I mean, if you think about, it's something that, is probably going to impact your higher earners more than your lower earners, because the assumption is that, it's more your wealthier individuals that are able to buy these pre-cut or prepared fruit and vegetables. But I was thinking of, the vendors on the street, those that sell Fed Cook on the street. A lot of them sell that Fed Cook with chips, right? And a lot of those chips are frozen chips. They buy them in the shops and then they fry them, sell it with the Fed Cook. Now, immediately we're adding 15% cost to their product, which I don't think is going to go down well. I think this amendment is a big one. I think that that market is quite a big market, and adding 15% cost immediately to all frozen fruit, vegetables, as well as fresh pre-cut ones, I think is a big change. I don't think that it's a clarification. I think it is an amendment. Because SARS itself has also released in previous years binding general rulings on what the zero rating applies to. And they were quite clear that your frozen vegetables that hadn't been treated except to preserve them in their natural state would still qualify for the zero rating. So, I mean, this definitely is an amendment and not a clarification. So I expect this one to have a big impact. And I think we're going to see some impact on Woolworths, particularly over the next few months. Then the other interesting amendment was related to the prescription period for input VAT claims. So on input VAT claims at the moment, you have 5 years in which to claim your inputs. And I think the problem here is that SARS cannot police this. Right? So if I, in a current period, claim an invoice that was dated for October 2023, and SARS is conducting an audit on the current period, there is that risk of duplication. So, how sure are they that you did not claim it in a previous period and are claiming it again in the current period? So it is a real risk from a SARS perspective. The solution that they've proposed is quite interesting. So what they proposed is that the VAT Act be amended and input claims must be made in the original period to which where that entitlement arose. Now, how that would work practically, does that mean that if that invoice is dated October 2023, I reopen the October 2023 VAT period and claim it in that period, will that mean that SARS will then allow for reduced assessments to be lodged? Or will it be a formal application? Because currently SARS system is such that if you request a correction of a VAT return and it results in a refund, SARS just does not process it. The system just blocks it. It only processes an assessment where it's an increased assessment and not a decreased one. So systems will need to change. Other issues are related to whether interest is actually going to be paid on that refund or not. I suspect not. SARS is very reluctant to pay interest on VAT refunds. But I think this is probably SARS' way of saying, well, we want to make sure that there's no duplication in other periods, which is actually very difficult to police. Then other proposals related to non-residents. So a very specific provision here for non-resident lessors of parts of ships, aircraft, and rolling stock. Now, previously, these types of lessors were required to register for VAT, and an amendment was made in the 2023 year to remove the requirement that these lessors register under certain circumstances. Now, the problem with deregistration is that you could have output tax consequences because you cease to be a vendor. Now, that was unintended. So the amendment is to provide relief from this consequence. Then moving on to zero rating of supplies to foreign subsidiaries of companies based in South Africa. So essentially, I mean, you have foreign companies that may be regarded as resident in South Africa because they effectively managed in South Africa. And usually this is in the context of foreign subsidiaries that are managed here in South Africa instead of in their local jurisdictions. Now, the definition of resident for VAT purposes refers to the definition in the Income Tax Act. And the unintended consequence of this is that your zero rating provisions cannot apply because you have to provide the service to a non-resident. Right? Now, where the service is actually being consumed outside of the country, so where that foreign company doesn't have a permanent presence in South Africa and actually consumes that service outside of the country, in theory, that a zero rating should apply. And the amendment is to exclude such foreign companies from as being residents for VAT purposes, which is, I think, a welcome proposal. Then, for electronic service providers, there's a proposal to revise and update the electronic services regulations and relevant sections of the VAT Act for changes in the digital economy and ease administrative burden. Now, the idea is for the scope of the regulations to be limited to suppliers of service to only non-resident vendors supplying to non-vendors and end consumers. Now, this seems to be a bit of a backtrack because originally when these regulations came out, that's exactly the target. It was the B2C market or segment that was being targeted by the regulations. And in subsequent periods, it was expanded to include B2B transactions as well, which actually don't result in any additional revenue for the fiscus, because if it's B2B, generally speaking, you've got VAT inputs matched by VAT outputs, and there's no additional revenue to the fiscus. Now, it seems like we're backtracking and saying, well, you know what, only in a case where we would be likely to receive more revenue, do you now need to charge the VAT? Which I think is a bit unfair to these electronic service providers after putting them through all that trouble now to reverse the position and say, well, actually, it's not required anymore. Then an amendment for that would be quite useful for gold, well, not useful, I think would have a big impact to gold miners. So at the moment, there is a domestic reverse charge for gold and goods containing gold. And it was introduced to curb fraud schemes related to gold products in the market. So there was a lot of schemes in the past to manufacture VAT refunds. And essentially with this domestic reverse charge, it's the buyer of the goods that must account for output VAT thereon. So typically you'd have the seller who have to charge output VAT. In the domestic reverse charge, it's the buyer that has to account for the output VAT on the purchase of the goods. Now, the regulations at the moment do not apply to holders as defined in the Minerals and Petroleum Resources Development Act. So these are generally holders of prospecting, mining, and exploration rights. Right? So your gold producers. Now, what's come to Treasury's attention is that fraud has been detected in the primary gold sector as well. So this means that from a Treasury point of view, it seems like the answer is to apply then the domestic reverse charge for the entire value chain, from producer right down to other participants in that in the gold value chain. So something to look out for in the next few months. Then from a gambling point of view, previously SARS issued rulings to taxpayers to cover various aspects of that in the gambling industry. And, I think there's been definitely a move away from rulings and rather a move towards encoding these rulings in legislation. So then it's clear that it applies to all taxpayers rather than, having a ruling that sort of only applies to a certain grouping. Now, in the current year, the proposal is for amendments to be made to incorporate specific rules for table games of chance. So those rules will be written and included in the VAT Act in the next year. From an Islamic financing perspective, there are some amendments that have been proposed for the Mudaraba type of financing arrangement. And currently, Section 8A of the VAT Act does not cater for Mudaraba financing arrangements. And the reason for that is this kind of arrangement is primarily used for deposit taking by banks. And that's usually in the form of cash, and thus has no VAT consequences. It's unclear exactly what the amendment is meant to cover. Presumably, there was a request from taxpayers or practitioners for an amendment, and presumably to cater for deposits in kind. So not cash deposits and maybe transfers of assets instead. So it'll be interesting to see how this particular proposal is worded when it comes through. Then with regard to the clawback on irrecoverable debts. So the VAT Act is a bit different from the Income Tax Act in the sense that if you're a buyer of debt and that debt included an amount of VAT that was previously paid. So even though you weren't the original supplier that gave rise to that debt arising, and you're just the acquirer of the debt, if that debt went bad and it was on a non-recourse basis that you held that debt, you could claim the VAT input on the write-off of the VAT component that's included in that debt amount. Right? Now, the problem with the legislation is that while it allows for the write-off of the VAT, so in other words, for the taxpayer to get a benefit, if that debt were to be recovered later on, unfortunately, the way the legislation is written, there's not a specific reference to include that bad debt recovery in the as output VAT on recovery. So it's an amendment to correct this position. Then with regard to educational institutions, currently educational institutions, if you meet certain requirements, it's the institution itself that is subject to a VAT exemption, right? For educational services. Now, the problem is that certain educational services are provided to third parties. So in other words, for example, if an educational institution is contracted by an employer to train, say, 10 employees, the educational service is actually provided to the employees, but it's the employer that's paying for that service. And it's unclear whether the VAT exemption actually would apply in that kind of scenario. There is a bit of debate in the market as to whether it does or not. And I think there's variation in treatment. So there's an amendment that is meant to come through to clarify that position, to either say, yes, it's exempt, or say, no, it's not exempt in certain circumstances. So we'll wait to see what happens there. Then with regard to the VAT on imported services, now remember, if VAT on imported services doesn't apply to all recipients of services, it would really apply to those recipients that are not vendors or make mixed supplies, for example, like the banks and your insurers and those kinds of entities. Now, when VAT needs to be paid on imported services, you have a 30-day time frame in which to do that. It's often very difficult to meet that 30-day time frame. And that 30-day time frame is counted from the earlier the date of the invoice or the time any payment is made for the supply. Typically, in practice, it's only when the payment is made that this, the tax team detects that the payment is subject to VAT on imported services, and that's typically when the VAT is actually accounted for. It's usually, the invoice is usually missed. So the proposal is to extend the time frame to 60 days. I think just from a practical point of view, so that people or companies have sufficient time to be able to get their sort of paperwork in order and then declare the VAT on time. Then the next proposal relates to non-resident vendors who have no or limited physical presence in South Africa. So under certain circumstances, non-residents may be required to register as vendors despite the fact that they don't have a physical presence or they have a limited presence for a short period of time. Now, one of the practical difficulties is appointing a representative vendor who resides in South Africa and the opening of a bank account in South Africa, especially where you don't have a physical presence. As a result of this, in previous years, the requirement for local bank accounts were relaxed for certain electronic service providers. Going forward, it's been proposed, particularly for electronic service providers, that while they have to appoint a representative, that representative does not have to reside in South Africa. So typically, the representative taxpayer must reside here because SARS wants a door and they want a door to knock on and a warm body to arrest. So in the case of these electronic service providers, SARS is saying, well, okay, fine, we'll accept a representative that is just not located in South Africa. What is more interesting for me is that this dispensation will be extended to other non-resident vendors who have limited or no presence in South Africa, but only under specified circumstances. And it'll be interesting to see what those specified circumstances are, because this is a very, well, I would say it's a common problem where you have foreign entities that do have some activities in the country, but not enough, not a physical presence. But they still have a VAT registration requirement. Then with regard to overpayments of VAT on importation of goods and imported services, currently the VAT Act does not adequately cater for refunds, especially where the refund is due to a person who's not a registered vendor, right? And in this case here, what SARS wants to make, what Treasury wants to do is facilitate that the repayment of the refund to these non-vendors when it arises. So from a carbon tax point of view, I'm not going to go through every single amendment in detail, but I just want to pick up the big things. The first thing is the tax rate has been amended. The tax rate last year was 159 Rand a ton. It's now been changed to 190 Rand a ton from the 1st of January 2024. Now, what is unclear to me is how future increases will be phased in, because previously the announcement was made that they're targeting a $20 per ton price by the end of the first phase, which essentially is the end of next year. Right? And a $20 a ton means we'd actually have to double the current tax rate, which I think will be very difficult for industry to absorb. So that remains to be seen. And just bear in mind that the idea is for the price for carbon per ton is meant to rise to $30 per ton by 2030, which again is a steep increase. Whether industry and whether the economy can actually absorb it, I think is questionable. But we wait and see. But certainly the increase for the current year doesn't bring us anywhere near that $20 mark for the time being. Then with regard to emission factors, I don't want to discuss it in detail, but just for you to know that when it comes to fuel factors for fuel types, as well as fugitive emissions, there are additional categories that have been included in the carbon tax act. So the carbon tax is going to apply to a wider range of fuel sources and a wider range of industries as far as fugitive emissions go. Then with regard to the renewable energy premium deduction that certain carbon taxpayers are entitled to, they would still continue to be available when the power purchase agreements are transferred to the National Transmission Company of South Africa. So currently those PPAs are with Eskom, And with the restructure of Eskom, they will be transferred to this transmission company. The idea is for eligibility to claim the deduction will continue for those taxpayers. Then the big thing on this slide that I want to highlight is the alignment of the carbon tax and the carbon budget. Right? So those carbon taxpayers that participate in the carbon budgeting process with the Department of Forestry, Fisheries and Environment, at the moment qualify for a 5% allowance, essentially a discount on the carbon tax that's payable. That carbon tax budget sort of allowance will come to an end in December this year. Right? And the idea is that going forward, instead of a carbon budget allowance being provided, another allowance called the offsets allowance will be increased. And with regard to the carbon budget, those taxpayers that are within their budget won't suffer any punitive measures. But if they exceed their budget, there will be an extra, well, it will be the price per ton will be 640 rand a ton. Right? In other words, so to give an example of a taxpayer that committed to emit only 200,000 tons of carbon in a year and ended up emitting more than that, for every ton in excess of 200,000, the price per ton will be 640 rand, which is more than 3 times the current tax rate. Right? So that's quite punitive. And the mere participation in the carbon tax budget, the 5% allowance that you're entitled to at the moment, will fall away when that comes into effect. So something to look out for. I think what's going to be really important is for these taxpayers to make sure that they budget properly and they monitor their emissions so they don't exceed what they've committed to. Then moving on to fuel levies, there was some good news that we weren't going to be paying more for the general fuel levy and the road accident fund levy. There were small increases, relatively small increases for the carbon tax on fuel. Higher one for diesel of 3 cents versus a 1 cent increase for petrol. And this will be effective on the 3rd of April, 2024. But if you look at the percentage of the pump price, I mean, the fuel levies are still a significant portion of our pump price. Almost 30% of the total fuel cost that actually goes to the fiscus in the form of fuel levies. So it's still a big proportion of our fuel bills. Then typically, some taxes go up every year on alcohol, tobacco, and last year excise duties were introduced on vaping products. And as Mike mentioned earlier, a lot of these increases are ahead of inflation. I think the higher these excise duties go, the more incentive there is for the illicit economy to thrive. And I think we're going to start, it's already happening, but I think we're going to start seeing more of the sort of formal taxpayers that are trying to be a bit more diligent are going to be crowded out because, I mean, it just makes sense for consumers to dodge the tax and buy something that's illicit rather than mainstream. Then with regard to miscellaneous taxes, with the sugar tax, the health promotion tax, there's no increase, but that was in line with the announcements from last year. There have been increases made to the plastic bag levy, incandescent globes, as well as the motor vehicle emissions tax. And then these are quite interesting proposals from a tax administration perspective. So currently, when you register a new company at the CIPC, that company is automatically registered for income tax purposes. But unfortunately, even though the directors have been appointed, there's no public officers yet. So if you want to do anything with that new company, for example, apply for a VAT registration, you have to appoint the public officer first. There is a grace period of 1 month that a new company has to appoint a public officer. The problem is not appointing the public officer. The problem is it starts to accept the appointment of the public officer. One of the good things that seem to be proposed in the current year is that when these companies are going to be registered, not only will directors be appointed, but a public officer will be appointed to start with as well. So you will have the public officer from the start. So that appointment will not need to go through a different process at SARS. I'm hopeful that this does come into fruition. because currently these public officer appointments are holding up various VAT registrations and so on. So it would be good if it does come through. Then another amendment, SARS wants the power to require a person to attend the offices of SARS in person to be interviewed regarding their tax affairs. So they can require you to appear, almost like being summoned. It seems like it's in various circumstances that this could arise, but they want that, want to have that power to require for you to be there in person rather than just communicate with them in writing. Then with regard to original assessments, this is a term that is defined in the Tax Administration Act, and there's various consequences that flow from having an original assessment or having SARS issue an original assessment. But the problem is that the legislative framework only covers certain types of original assessments. So we're going to see some amendments coming through to I think, widen the scope of the provisions related to these. And then a very interesting amendment regarding ADR proceedings. So currently, alternative dispute resolution proceedings are only accessible at an appeal stage. And, it could take some time to get to an appeal. The idea here is to perhaps access the ADR proceedings earlier in a dispute. So, for example, at an objection stage. This would be quite useful if you're dealing with an auditor, SARS auditor that resembles a donkey that doesn't want to move its hind legs. So it would be, quite useful to have a third party come in and be the voice of reason. The only thing I can see with this is that, currently the ADR process does take some time. I'm not sure that SARS has sufficient resources to allocate people to deal with these kind of issues at an objection stage, so that could be a sticking factor. But anyway, I mean, if you can access sort of a reasonable third party or person, road shading on my side, so I've gone blank, sorry. But yeah, so it'll be interesting to see whether that comes in. And then to end, the IRS says that you must report your illegal activities and stolen property. When I saw this on Twitter, I thought, it can't be true, but apparently it is true. And I thought, well, which self-respecting a thief or drug dealer actually reports their income to the Revenue Authority? And I saw a Twitter comment thereafter that said, well, actually, they know, IRS knows that you're never going to report it, but the fact that you don't report it means it's evasion. And like how they brought down Al Capone, it will be easier to arrest you because of evasion than trying to prove that you were criminal and conducted all sorts of criminal activities. But it will be interesting to see if South Africa follows suit and has these kinds of questions on the tax returns going forward. And with that, I'll hand back to Mike.
Thank you, Yasmeen. Appreciate your insights on these taxes. And I think maybe just before we close, because we are a little bit over time, there was a last question that was asked of Francois. And maybe if I just read the question, Francois, if we could have your thoughts on this. It says, in stimulating economic growth in South Africa, what should be the minimum level of BER, given that South African corporates hold over R1 trillion of cash with banks?
Yeah, Mike, the important thing here is we want corporate savings to be as high as possible, because consumers are not saving, governments are not saving, corporates are the only real ones that are contributing to savings. So against that background, if government starts saving, stop this saving, stop running budget deficits, that could potentially turn things around. But in the absence of that, the level of savings has a powerful explanatory relationship with prosperity. And the mechanism is, as I've mentioned, savings drive investment. If you invest, it circles black, the economy should grow via the investment, and investment would generate prosperity. But this is not to suggest savings should be as high as possible, i.e. the savings rate in the country. In fact, savings and investment rates above 40% of GDP tends to translate into negative marginal returns on investment. So the benefit of saving and investment would actually wane through overinvestment. You can think of China's ghost cities. However, the levels much below 40%, the top end of the sweet spot, let's say that's 40%, economies gain by increasing savings. As a rule of thumb, countries with savings above about 25% of GDP reap significant rewards when it comes to quality of living. Though I should mention that this varies with countries' specific level of development. So South Africa has a woeful low savings rate. Our gross savings rate is about 14 to 15% of GDP. So compare that to champion savers like Singapore, for instance. Savings rate has been steady at more than about 40%, for some times, and has been reaping the benefits of that too, or the rewards. So I think how much corporate save? Well, enough to make the savings pool large enough so that we can actually fund investment from that is the short answer.
Thanks, Francois. Then in closing, I'd just like to thank the panelists, Francois Fouche, Roné, Robyn, Berger, and Yasmeen Suliman. Excellent presentations and insight into the 2024 budget from an economic and a tax perspective. And then also thank you to all the attendees. We really appreciate your attendance. And yes, enjoy the rest of the day and enjoy your Friday and enjoy the weekend. And we'll see you next year.